Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Brian Seidensticker. He is the founder and CEO of Tax Sales Resources. His platform supports asset managers overseeing more than $2.5 billion in assets under management. Annually, it tracks over 9,000 auctions nationwide and processes data on 2 million plus on properties. As co-founder of Mount North Capital, which manages 45 million in assets, Brian brings nearly 2 decades of experience revolutionizing how investors access and analyze tax lien opportunities. So, Brian, love the opportunity to dig into something a little different than normal, and for me and kind of the audience, I think this is going to be right up that alley.
Well,
so
yeah,
looking forward to the today's
great
conversation.
Introduction. You got to do my introduction every time. I think, Keith. I appreciate it. Thanks for having me on.
There you go. Yeah, thanks. Appreciate it. And I love to just start, Brian, really with your background, where you grew up and what led you to investing in real estate and specifically, tax liens.
Yeah. Well, I'm a native Montanan. I was born and raised in Montana. I was 4th, 5th generation. But anyway, yeah, I did not grow up with boyhood aspirations of being in the tax sales space by any means. I went through my phases of wanting to be a farmer and a rancher, and eventually landed on aerospace engineer. And so actually by trade or training, that's what I went to school for down at Arizona State, and spent the first roughly 10 years of my career in the missile defense space for a contractor, working on and basic programs that shot other missiles out of the sky and maybe space sometimes. So it was really cool. And it sounds really cool, and it did have moments of really, really cool. My journey of how I got into the space was a combination of I realized, and still like later when I got my first couple internships in college, realized that maybe engineering is not exactly what I thought. I think I dug more what eventually realized is more of the technician role of hands-on building, as opposed to the engineering is much more staring at a computer, analytical. But ended up loving what I did in the industry. I ended up in as a systems engineer and kind of a jack of all trades, but wasn't an expert at any of them, which suited me well. So there's kind of that realization. And then I also went on vacation, a longer vacation. It ended up being 6 weeks. And I was very nervous about leaving for that length of time because, even though it's corporate America, I just, thought coming back is going to be an absolute nightmare, what's going to fall down. And I left, I came back, and it was almost like I never left. I stepped right in, almost like nothing had happened. And it was an epiphany for me that, although I felt like I was running every day, it was how much little progress I was actually making on a daily basis. And I certainly wasn't cool enough at the time to say I'm out, right? I'm going to go do something else. But that was definitely the first time in my mind, I said, I got to find something else that scratches that itch of feeling an accomplishment on a daily basis. So for me, that side thing ended up being real estate, again, on the side, buying and selling investment properties. This is in 07, 08, and then ended up being upside down on one of those properties, which we were doing in Montana. And being upside down was delinquent on taxes. And an oddity of the statutes in Montana is still today is every potential investor that wants to buy a tax lien on your property has to send you a certified letter. And so I didn't just get one notice from the county. I got 30 of them from all these different investors that were stating with different terminology or different exact words, but something along the lines, if you don't pay your property taxes, I could end up owning, or we could foreclose on your house. And although that's not what happened in that particular scenario, it definitely opened my eyes to this whole, space of tax liens initially and eventually tax deeds as well, and pivoted. I took care of that particular scenario and pivoted and started buying tax liens on a small scale, again in Montana and Wyoming. And that's really how I was introduced to the space, kind of on the wrong side of a tax lien, which is kind of odd. It really wasn't until 2010 is when Taxel Resources, the company, came about, and it was really a suggestion from a friend who saw what we'd put together for internal use. And I was an engineer, I could build a basic website, and we were just collecting, I'll say, simple information that just didn't exist right on the internet at the time, which is like when these auctions occur, where they occur, the list of properties involved in them, and then some basic property data, so you can just decide which ones as investors to buy or not to buy. And that just didn't exist. And so what we were doing is kind of writing the phone book. But a friend had suggested, hey, if you made that available to the public, you might be able to offset some of your overhead, and that's what we did. But long story short, within a couple of years, it dropped, the advent of buying liens because I was making way more money on the software side, providing it to other investors. And at the end of the day, there's only so much time in a day. And that's really what got me, I guess, launched into the space.
Yeah, no, that's neat. So you did it initially just by accident, kind of receiving all those letters, and then what about so receiving that, you saw that there was an opportunity for investors, at least that were coming after your particular property. But what did that spark? Like just research at that point and saying, okay, well, number one, I got to get these taxes caught up, but the other side of that would just be like, you saw that this was an opportunity. Did you start researching it from there, or how did you find out about how to be on the other side of that?
Yeah, I guess I'm trying to remember the exact book, but it was something like Tax Sales for Dummies that I bought and read, and actually there ended up being a few books. There's one based on the Florida model, which is the Fast Five. There was one in New Jersey by a prominent attorney there. And just doing that research, eventually realized at that time, right, it was like, wow, this is a pretty large space. There's banks that do this, right, and there's got to be a fairly big enough. I didn't know how big at the time. Eventually learned, it's about a $9 to $10 billion an annual, industry, right? That I don't know what size the NBA is today, but a couple of years ago, it was roughly the size of the NBA, and no one's ever heard of the tax sale space. So that's, it was, some initial like curiosity that turned into research, that turned into, I guess I'm a, engineer. I like to, go figure out how to make this happen. So figured, if real estate at the time was not the thing that you want to do in 2007, 8, right? Maybe buying tax liens is a good way to make a little extra cash on the side. And that's really what started it all.
Yeah. How about just for the audience, maybe you can explain it. I get it. It's going to be different from state to state when it comes to this stuff. But like, you started in Wyoming area and Montana. What are the rules on that? So you get behind on your taxes. How far behind are you typically when you start to get some type of a tax lien, I would assume. And then from there, when does it become public knowledge? When does it become something that is a viable potential option for somebody to purchase? And I'm sure there's circumstances that go along with not just being behind on your taxes, but just being probably behind on bills in general that would, make it somewhat of a more of a potential for this to be somebody who would potentially lose their property to something like this. But I guess tell us a little bit about kind of the timeline and the breakdown and what you analyze when it comes to that. And it doesn't have to be for those two states specific, but just in general.
Yeah, I think, and like you said, every state's process is different because it is governed by state statute, but they all follow something along these lines. And really starts with, right, like you said, what happens if a property owner doesn't pay their property taxes, right? Now the timeline does vary wildly from, I think the shortest time frame I've heard of is less than 6 months to multiple years of being delinquent on your taxes before anything is actually done. And that first thing that is done is usually a tax lien or tax certificate is placed on your property. And basically what is happening there is, counties, right, that are issuing these counties, well, some states go by city or municipality, but I'm going to say county, they're looking to balance their budget, right? The dollars that they need go toward paving the roads, right, paying teachers, paying firemen, all those things. And so, if one person doesn't pay the property taxes, not going to, ruin their budget, but one of the largest sales or delinquencies, which is Cook County, can be on the order of a couple $100 million, right? It's a significant dollar amount that unpaid property taxes, that's a lot of dollars that the county could use for those services. And so the mechanism, I should go research the actual date of when tax liens were invented, Keith. I don't know the exact date, but it was basically invented as a mechanism of enforcing the payment of property taxes. And so what happens is the county says, hey, I need to balance my books. I'll use one property as an example. Like there's $1,000 in this particular property and taxes that weren't paid. If you investor, right, can pay me that $1,000 so that I can go balance my budget, then if and when vast majority do, the property owner eventually pays their property taxes, the interest and penalties that they pay, I'll give to you, investor. And so you get to make that money instead of the county, right? Now, in reality, there's usually some of that goes to the county, and it's complex, but that's the deal that's made. Now, what the investor gets in return is they own a lien on that property, and that lien is not that dissimilar. I like to call it micro mortgages because it follows a similar path, right? Hey, I got a lien on the property. I don't own the property, right? I have a lien on the property. And so if the property taxes never get paid, then the next step happens. And so just like a mortgage foreclosure, if you never pay your mortgage, then eventually they start the foreclosure on your property, and that's what happens. And usually this is several years down the road, right? So now we're multiple years into the delinquency. Then they start a foreclosure process. And that foreclosure process in most states culminates in what we call a tax deed sale. And that's where they're actually auctioning the property off, and whoever's buying that is getting a deed to the property, have ownership rights, not just a lien. And that's really how the two interact with each other. Usually starts with a tax lien, right, and culminates in a tax deed, right, after there's been some sort of form of foreclosure. Now, all of the statutes and the mechanisms in the middle do vary, from state to state, but that's a pretty good overview of exactly what happens on a general level anyway.
Yeah, that makes a lot of sense. And then the play on this, is it really to ultimately own the property, or is it to the spread on those fees and everything that accumulate, or both? I mean, obviously it can be both, but what do you see in general when you're? I mean, to me, it seems like you look at what the tax bill is. Well, this all varies, right? So I guess just let's start with what's the general play on most of what you guys are buying in your fund. Are you making most of the spread on the fees, or is it a combination of that and actually taking ownership of the property?
Well, the one thing that happened in the last 5 years was there's a Supreme Court case called Tyler Hennepin that essentially eliminated what used to be, the advent of buying a lien and being able to own the property at the end of the day. And Tyler Hennepin said that's not constitutional. There's a lot more complexity to that court case. So don't take that as the absolute, word of what came out of that. But that is a big thing that came out of it. And so nowadays is there's really two sales that occur, right? Or likely two sales. One is going to be the liens, right? So if you're kind of the passive investor that just wants to earn a rate, right, and you're not looking to, actively manage real estate, then you buy the tax liens, and there's those auctions happening across the country all the time. And then there's, the real estate, investors that are, looking, to acquire the real estate, and so they'll attend those tax deed auctions, right? And rarely are investors playing in both. The fund that we operate actually partners with folks that are focused more on the deed side and the real estate end of it. But there are several very successful funds out there that focus on the lien side, which is really more the interest play, if you will, and much more of a paper, play. And I'd say most of those guys really have no interest in owning the real estate, right? And that's really in general where the industry has gone. There used to be 5 plus years ago, there used to be some fairly sizable funds that would buy the liens, and then without the second deed sale, which now is being required by the result of that Supreme Court case, they would look to eventually own some of that real estate for the back taxes that there was paid. Now, in reality, it's a very, very, very small fraction that would end up in that, but that call those like a hybrid investment strategy, and that strategy has basically gone the way of the dinosaurs with this latest the Supreme Court case.
Okay. And when we talk about, percentages that can be earned, and again, I get it, it's going to probably vary from state to state. There may be some limits that are put in there, but what is expected if somebody's behind on their taxes and you're coming in, you're making the county whole by, paying those off and buying the certificate or the lien itself, and then you're earning a percentage. Eventually, it's hopefully going to get paid off. I mean, at some point, there may be a sale, there may be something that orchestrates the back taxes being paid, or maybe they just get caught up at some point. What percentage is typical for tax liens?
The range varies immensely because there's like the potential interest that's governed by a statute, but then there's the real interest because the auctions of how these are sold, really limits, right? It's a competitive nature. And so those auctions, there's a few different methods, but the two main ones are either what we call a bid down percentage. And so you're going to the auction, and yes, people are raising their paddle, but what they're yelling, or digitally today, clicking a mouse button, what they're doing is opposite of what you would expect, right? Instead of saying, hey, I'll pay $10,000, $20,000, $30,000 like a standard property or any auction that you have seen on TV, they're saying, I use Florida as an example, they're saying, hey, I'll accept 18%. That's the maximum that you could potentially earn in Florida. But then the next guy's coming in and saying, hey, on that lien, no, I'll take 17.5%. And the next guy comes in and says, no, I'll take 15, right? And then eventually it bottoms out at some point where, nobody's just willing to take less than whatever percent. Now, like in reality, what I like to tell folks is, what could you get out of this? If you're buying like a couple $100,000 in liens, you could make, 10 to 15% annually not with like total ease, but, we could certainly help point people in the direction of how to achieve that. Now, for some of these funds that are placing $50 to $100 million a year, you can't do that, right? So those guys' expectations is more down in like 5, 6, 7, 8% that they're earning. And so you just got to kind of keep that in mind, depending on how much capital you're looking to place, right? You got to be realistic on what your earning potentials are. Now, I say that, I've heard stories of people winning stuff and earning 36% or 24%, right? In theory, that stuff can happen. It's just not normal and not really scalable. Like, you can't predictively say, I'm going to go buy a bunch of those and, Wall Street's going to give me $1 billion and I'm going to go make that happen. That just doesn't exist in the space. Now, on the flip side, right, for tax deeds, right, you're buying the real estate. So your upside is not unlimited, but it's however well you did on the purchase and what do you have planned for it, your upside is not limited by whatever the interest rate is. It's whatever your end goal is on that piece of real estate. And that's an advantage. a disadvantage, right? Is you got to manage that asset. You're going to be into that asset way more, right? Instead of $1,000 for a lien, you're going to be into it for $80,000, right, to buy the deed. So it's a significant higher, commitment of capital and risk involved.
Yeah, for sure. And so tell me, I guess, a little bit about what is the exit strategy on these, right? You buy into them, and you'd mentioned kind of an annual return, but and I would assume, and maybe it's a bad assumption, but on some of these, you're not actually earning the return, right, until they actually make payment, right? So what is the exit strategy, or how do you receive the payment at some point?
Yeah, so
From these.
and then there's good nuance, right? It's not like you're earning that interest rate and getting that cash flow on a monthly basis. You are instead, right? It's accumulating, right, until the vast majority of them, the exit strategies, whenever the property owner pays their property taxes, they pay that interest rate on top of it, and that's when you collect all of your return when that property, the term we use is called redeems. And 99% of all properties redeem at some point in their history, right? And that might be a month later, that might be 3 years later, right? Depending on the state and the property type and all that fun stuff. But that is the model, right? You can't rely on it for cash flow.
Yeah. Okay. And so the redeem happens when they finally pay it, and that could be because they're faced at that point. They've built up enough that they could be faced with a foreclosure on the property itself, and so that's causing them to do it. Or maybe they've gotten to a spot where they're going to be doing refinance or a sale of the property, and obviously there's got to be liens cleared up at that particular point in time.
Yep. Yeah, I think there's lots of different. I mean, the two driving factors are they just didn't know, and then after the lien is sold, you get a bunch of notifications in the mail, and property owners go, oh, because typically with mortgages, it's all part of your mortgage payment, right? The interest or the taxes and insurance are included in that, and so the mortgage company's paying that, and so you do see that quite a bit. As once the property's paid off from a mortgage, the property taxes go delinquent because they've never had to pay property taxes out of their own bank account for 30 years, and so it takes a cycle of them getting those notices, calling the county, and going, "What is this all about?" Well, you haven't paid your property taxes, and then they go ahead and pay them, and that's usually pretty quick. And then there's another spike of redemption likelihood out toward the end of the lien life cycle, where it does start to look like it's going to be foreclosed on. A bunch of new notices go out, saying, hey, you could lose your property, take care of this. And the vast majority of the people take care of it at that point in time. Correct.
Okay. Is there ever any kind of a strategy for getting, I'm just thinking of a property I bought, which was just crazy how many years worth of loans. Obviously there's a whole nother business on people that, become delinquent and have these tax liens out. And then there's people that will lend them the money, right? But they're putting a lien on the property to do so. This is in Texas specifically, I'm thinking of. But, I was just surprised year after year after year of this. And so they're earning, they are actually probably earning from that standpoint because they've created a loan that this person is essentially paying back,
right?
Probably on a monthly basis at a high interest rate, and they still got the lien to secure it type of thing. But is there any outreach from in what you guys do to the customer to give them maybe a more palatable way of paying back those taxes, or is it pretty much you're playing that they're gonna end up making the payment in full at some point?
Yeah, most states, right, have statutes that very limit the type of communication that can come from the lien holder. And so because the relationship is really between the constituent, the taxpayer, and the county, right? So the check is actually being sent to the county. The county's then in turn around and sending that check to the investor. There are some states where it's more direct, like you mentioned. Texas has a unique process, and that process is really only Texas and Nevada have statutes that allow that as well. And there are some states that allow, say, a payment plan to be put together, but not in a true lending sense. But most states say, hey, you can't contact the previous owner until it gets to at some stage down the road where it starts to look like a foreclosure. Then you can send these specific types of notices to the taxpayer. Now, that's not to say there may be some people that don't follow all of those rules, but the statutes say that you're not supposed to.
Okay. Okay. And then let's maybe talk a little bit about the software as well. I guess, yeah, let's talk a little bit about the software, but I'm also curious on another thing. I'm just curious on, what is a very favorable state to deal in? Or are they all pretty well the same when it comes to this from an investment standpoint? I mean, almost states charge some type of a taxes, although it does vary dramatically. Again, Texas being one of the heftiest that I've seen as far as property taxes is, we don't have a state income tax. So they definitely make up for it on the property tax side, where I've got property in other states and it's like a fraction of what it is. It's almost funny that it's even a tax bill because it's so small, but,
Yeah, well, so the platform itself is, I like to compare it to Zillow. I think of Zillow as far as like the visualization of it, and these properties have tax liens, but it's just specific to just tax liens and tax deeds. But as far as finding the auctions that are coming up, researching the properties, the data that you get. I mean, if anybody's familiar with Zillow, can kind of pretty good picture in their mind of what the platform does. As far as, what states are better, I mean, it really depends on what the goal is, right? That one thing that COVID did is a lot of counties that never had their auctions online, like pre-COVID, it was less than 10% of counties had their auctions online, and post-COVID, it's more like 70 to 75% of auctions now have or counties now have their auctions online. So there certainly is more user-friendly from that perspective, but the downside is that more user-friendly makes it more competitive, right? And so depending on what your end goal is, right, if you're wanting to kind of dip your toe in this space and go with an online auction that's easy, right, Florida is probably one of the most common. It's also the largest, market nationwide. They have over $1 billion in delinquencies every year, about 500 million of those that end up getting sold. And all of those auctions occur in May or June of the year. And so there's just a lot going on in that period of time. And then there's, states that you might get a higher return, but you got to go to the live auction, in the middle of Illinois, for example. And yeah, you can probably get a great return, but the logistics are more expensive. So it really just depends on what people are searching for. And then there's, states like New Jersey that it's at the city level. There's 566 municipalities in Jersey that have sales. And so they're happening all throughout the year. So the downside of Florida is they happen once, right? And then redeem. What do? Right? You got to wait 10 months before the sales occur again, versus, New Jersey is the sales are constantly happening, right? And there's some states, you mentioned Texas, they have them, on the first Tuesday every month, right? And there's some advantages of that as well. So I've been asked like, well, what is the best, investment area? And I say there's as many answers as there are people, right? Depending on what you're looking for, from an ease of access, type of return, type of properties, how much you're looking to place, all that fun stuff. Keith, if that helps.
Yeah, it does. And then on the platform itself, when you're looking at these, are you seeing like names and amounts, or are you seeing what property it's tied to? What kind of level of detail are you getting? A glimpse of?
Yeah. So initially when we got started in the space, most counties, what they put out was a list of parcel numbers, a name, and an amount, right? And it's like, how in the heck do I make a buying decision? Because, there would be liens on, great $1 million houses, and there's liens on chunks of sidewalk and, borrow pit in between the highways, right? And you don't want to just buy without doing some research. So what the platform does is goes out and we aggregate all of that data. And so you can have, including the parcel boundaries, like where is this property? Is it a mailbox? Is it, or is it actually a single family home? Is it half of a duplex or the whole duplex, right? Those are all really important things to know. And that's exactly what the platform does, is give you all of those, I say data points for investors to make that decision based on whatever their criteria is.
Okay. And as a kind of experienced, this is your specialty, right? So what type of tax lien are you typically looking for? What is one that you're just like, man, this one for sure is going to get paid back? It's I would assume on some of the $1 million home ones, things like that, you're expecting that maybe this person just overlooked it and they're going to write a check. Obviously, there's others I've seen, again, kind of going back to just my own experience. I had to remedy a several of these on just personal property of mobile homes that were considered personal property in my parks, where we maybe decided to purchase those from the current owners, and then got a little surprise on back taxes that they owed, along with penalties and fees and everything else. And it's like, some of those, it's like, gosh, I can't believe you even let them go as long as you did without remedying them at some point, or foreclosing on them, or doing something, because some of these were just, it's incredible. The house wasn't worth as much as the back taxes were.
Right. And that does happen. I think you asked which ones do you want to buy. It does vary depending on the way the state works, right? And I'll use an example. Like in Florida, it's a bid down method, like I mentioned before, and actually you can bid down to 0.25%. Right. And people probably go like, why would you bid to 0.25%? That's not a very good return. Well, in Florida, right, and this isn't in every state, Florida has what's called a 5% penalty, right? So even if that person redeems tomorrow, they're going to pay you 5%. And so that's what investors search for, is those quick redemptions, right? If you can get 5% in that first month, right, that's an amazing annual return. And so that's what people target. Now, on the flip side, in Arizona, you can bid it down to actually, you can bid it down to zero, but there is no penalty in Arizona. So if you bid it down to there, that's what you're going to earn. And so, the investors that know that nuance and that difference, they won't bid down as far in Arizona as they do in Florida. And that's really the key there. Now, what we target, we actually don't participate in lien auctions. We work with partners, and we're kind of a capital partner for folks that are really in the tax deed space, so the people that are buying the properties at the auctions. And that's what we target is anywhere from vacant land, right, great vacant land, through most of it, the vast majority of it is single family homes. We've actually worked with some folks that bought commercial properties through that mechanism as well. Just keeping in mind that most of those properties are not like move-in ready, right? Including the commercial properties. They need at least some work, if not a lot of work, right? Because haven't had their taxes paid for multiple years. And so it's probably a lot of other maintenance that they haven't taken care of for multiple years. And you just got to have that mindset going into it.
Yeah, for sure. Now, are all of those different options coming up on the platform? Or is it just the tax piece of it? Are you are some of these showing actual auctions for the deed itself?
We track both.
The property?
Yeah, so both the tax lien and the tax deed auctions are tracked on there, and so anything that's available, and you can filter it by certain auction type if that's what you want to do, or location, all that fun stuff. Exactly.
Okay. No, that's pretty cool. And you said primarily, or at least a lot of them are single family, which would make sense, but you get some commercials in there as well, where it's just one that somebody has just gotten way behind on, I guess.
Correct. Yeah, it happens. Low percentage, but it definitely happens.
Yeah. Okay. And so maybe tell folks how, kind of the name of the software again, and maybe how they can find out a little bit more about that piece of the puzzle. And then I'd like to kind of shift gears from there and maybe go into, kind of the fund and the opportunity to invest, on having somebody else basically do the work for you.
Yeah. Well, the platform is taxsaleresources.com. And anybody that's learning or looking to get in the space and want to learn, there's a tab in there that's called resources, and there's a blog and podcast and stuff. You don't have to log in. It's all free. Obviously I'm biased, but I like to think it's some of the best information you can get out there in the space. It's like real. I'm ultimately not trying to sell anybody anything in those, right? It's like I'm interviewing an attorney on exactly how the process works in South Carolina, for example, or Louisiana, right? Because each state has its nuances, and you better know what you're doing, going into it. And I highly recommend anybody, before they do it, talk to an attorney, and at least you can get some of your questions answered, listening to an hour, conversation. And that's one less hour you got to pay an attorney, $400 or $500 an hour. So it'll, be a big saver on that front. But again, go to taxsaleresources.com and look from there.
Okay. Yeah, sounds good. And and to that point, there is big differences from state to state when it comes to when you actually buy the actual property, and when it comes to tax sales. It's a little different than some of the other types of foreclosures, although there's remedies that the prior owner has on a lot of these things, but the taxes can be kind of a nuanced deal, and so you got to know the rules that you're playing by, because you may think you got the property, and they may be able to reverse it if these people come up back with the dollars.
Yep.
So
You mentioned Texas exact example. You are buying the property at the auction, but they have at least 6 months to come out of the blue and redeem it. And if it's a homesteaded property, they have 2 years to come out and do that. So it's all stuff that you need to keep in mind. You mentioned the fund side. So Mount North Capital, which is our fund that we now operate in, and we're not a lender. We don't finance these for folks. We're actually a capital partner. And so we work with local, let's say, real estate investors, because they're not just buying tax deeds at this point. They're buying real estate, and tax deeds are just one avenue that they're buying that real estate. And we partner with them as a capital partner. So they identify the properties, we underwrite it, we go buy them at the auction, and so forth. And we found folks are either very interested in doing that work themselves, which is fantastic, right? We work with our partners and are always looking for partners. And on the flip side, there's investors that at the end of the day go, man, I love the asset class, but I can I just provide the capital to you and you go do the work. I don't want to do the work, right? Which I think a lot of folks, right, once they get into the space, would probably be in that category. And so when we structured in Mount North Capital, it is a 506c fund. And so it is open, I'll say, to the public, as long as they're accredited investors, and they could partake in the asset class. And we actually pay out a pretty good return, 16% as of today, 16% annually that we pay out quarterly. So you get 4% a quarter. And then you get to basically take advantage of those great deals, but you don't have to do all the work to find them. So we kind of, feel like we're making it a win-win for both sides. The folks that don't want to be in the space, they can earn a good rate, and the folks that do want to be in the space but maybe are capital limited, we put the two together. We're the fund in the middle, and we're going to help provide the folks that want to do the work with enough capital to do it at scale.
Yeah, no, that's terrific. And it sounds like a wonderful return opportunity as well. And so similar, on that particular, what are usually the exit strategies? How are you, you're obviously putting the capital up for some of these purchases. And I know it's not just the tax liens, as you mentioned, but how are they, how is the money getting replenished back into the fund, and what's the typical hold period, I guess?
So there's each partner kind of has their own unique model that they're executing. And so it's not it's not true franchise and the fact that, hey, here's how you make money, go execute it. Each partner that we work with has their own, mechanism. And that runs from, I'd say, those that, buy at the auction, do a very little work and they sell them as is, right? And that whole time is significantly less. There's folks that buy the properties and then want to do the remodel, right, and then sell it at retail, value to a retail buyer. There's some of those as well, and then there's folks that we work with that are buying them and they want to make them into rentals, and so they get it stabilized and ready for DSCR financing or normal bank financing, and they essentially finance us out of that scenario. And so we like to be in the assets as little as possible. We're opposite of a lot of real estate investors where we try not to go over a year. And so we're really not looking at it from a depreciation standpoint. There are some properties that do end up in that, depending on the state, but most of it is we like to have off our books within that first 12 months. But there are states, right, and statutes that require that to be longer. Like Georgia is roughly 18 to 20 months, just because you can't do it any faster. Texas can sometimes get a little longer, if there's a homesteaded property. But I think the key there is we're not a long-term capital solution. So if you're wanting to build a rental portfolio, that's great. We can still work with you, but you have to look at us as kind of that interim short short-term bridge financing partner. And you're going to need to find somebody, and you'll want to find somebody because ultimately the cost of capital interest to a DSCR lender is significantly less than what we'd get from a profit share standpoint.
Okay. So we've got listeners out there that are probably on both sides of that puzzle. And it sounds like with both of them, you have an opportunity, a potential opportunity there. So maybe an investor that's out there that says, hey, look, I'm already doing something similar, but I'd like to at least check out options to be able to have you start funding some of their projects. And, kind of what that would look like. Are you still taking investors from that standpoint? That are actually out there hands-on doing the work and just, that you can start to earn returns for your passive investors?
We do. And then we guess to differentiate between the two, we call them partners. So yes, we have about 35-ish partners we're working with today. Certainly many, many markets that we have no presence in and are looking to expand. We operate about, I think we're at about $65 million in real estate as of today. And we see significant growth potential in a lot of markets. So if you are looking for that type of partner, we'd love to talk to those folks, for sure. And obviously on the other end of it, it is an evergreen fund that we put together. And so it's not a closed fund. If you are interested, we can certainly talk about when and if they are interested, and B, how much and when they could come into the fund when the demand is there on the partner side.
Yeah. Okay. Fantastic. No, it's very interesting. And so what are some of what are the main states? You've mentioned Florida a couple different times. Is that, obviously that's one of the states, but where are most of your partners currently investing?
We're in about 14 different states right now. And I guess footprint wise, think of, Michigan, Ohio, all the way on down to Texas and that whole corridor. And then on over to, through Georgia into Florida, is most of our footprint as of today. And, in reality, we would go just about anywhere. There's two states that are off limits, New York and California, purely because of the squatter laws in those states just make it very hard dealing with this type of asset. But outside of those two, if you have a state that you are very successful in and it's not in that corridor, I definitely reach out. We'd still like to talk to you.
Yeah, sounds good. What do you happen to know offhand? Like, just more from a curiosity standpoint, but it is crazy how state to state, how people think that they're in some cases creating a law that makes sense, and which it ends up ostracizing, investors. In New York and California have many of those, but specifically you mentioned like the squatter one. Do you know what the specifics are on that and why that's just like a complete offhand?
I don't have the specific statutes. It really just comes down to with this type of asset, there's a lot higher percentage compared to normal real estate that ends up with occupants of some nature. In those two states, it's a very long process of dealing with that scenario. If they're not willing to work with you, like we more than typically work with folks, it's not their fault, right? Usually it's a tenant that has no clue that the previous owner was totally delinquent on their taxes. And so, that is not a scenario where we're, at least our model, we don't look to, get them out of the house. It's like, hey, we just pay the new partner instead of the old, old investor or old owner. So anyway, long story short, I don't know the statutes exactly. I just, talking to our attorneys when we put the fund together, those are two states that they highlighted as maybe we should steer clear of for now. Maybe not forever, but
yeah. Yeah, makes sense. Well, this has been great, Brian. I appreciate it. If you could tell the listeners maybe how they could find out more about potentially becoming a partner, or also how they can hear more about the fund and the opportunity to invest within your fund.
Yeah, so if you're looking more on the partnership side, if you want to go to taxsaleresources.com, I'd recommend just giving us a call. There's a phone number on there. Give us a ring. There's a real person on the other end. Just say, hey, I heard Brian on Keith's podcast talking about this capital program. We call it an accelerator program if you want a specific name, but the person on the other end is going to know what you're talking about, and they'll point you to the right person to learn more about it. On the flip side, right, if you're looking on the investor side, mountainnorthcapital.com is where you can go and learn more about that offering. Download the PPM and start the conversation on that side as well.
Okay, sounds good. And so they can go to that site. Do you guys also do any kind of like webinars or anything that you can have an opportunity to answer questions, or what does that look like?
We do webinars on the Tax Sale Resources partner side, and so if you want to attend one of those, there's one specifically on the accelerator program. There's one on the financing specifically associated with that. And you can hop on, learn more. We even have some previously recorded versions if you want to do it on your own time frame.
Perfect.
And then, we do have folks that if you just want to hop on and talk to somebody as opposed to listening for an hour, you can give us a call and talk from there as well.
Perfect. Sounds like a great investment. Sounds like really strong returns. And so I'd encourage everybody to check out Brian and his companies. And Brian, this has been great. I appreciate you being on. I have a couple other questions for you that I ask every guest. One would be, any advice you would give somebody who's maybe just starting out in their investment journey?
Yeah, I think probably the biggest advice I'd have is just be persistent. And don't get discouraged at the first sight of it not going exactly your way. I don't know that I've had a day in 15 years that's gone the way I wanted it to going into it.
Yeah.
And part of getting to where we're at now is maybe hard-headedness, right? And just saying, okay, well, this is the problem. How do we solve it? And not okay, I'm going to run away. And so be persistent, right? If you're on the the partner side and just trying to make your first investment into something new. Anyway, that'd be my biggest advice: is just stick with it.
Yeah, no, I think that's great advice. How about a book recommendation? It doesn't have to be real estate or investing related. It certainly can be, though. Just something you've read, though, that's been impactful.
Ooh, can I have two?
Yeah, absolutely.
Only because two have stuck out in my mind since I've read them for a couple of years now. One is it's called Mindset. I don't even know the author's name, but it's really about it's every scenario is about your mindset, and if you approach it with this is going to be a failure, it probably will be a failure. If you approach it with I'm going to succeed, then you're very likely going to succeed. And so it is a great inspirational book for me, really well written. So I highly recommend that one. The other one is, very unrelated, but it's called Outlive. And it's talks about this concept of what he calls health span. David, I think it's Attia, Joseph Attia. Anyway, the author is a doctor. And this concept of, right, there's lifespan of how long you live, right? Health span is more like how long you live healthily, right? And what can you do right now that would help you be active and spry when you're 80 and 90 and not, in a wheelchair. And it's amazing how, simple habits you could do throughout your lifetime that would highly increase your chance of being that spry person older. And anyway, it's more of, think of it as like preventative maintenance as opposed to reactive maintenance. And for me, it definitely hit home. And some of the things that I could do and my family can do now to prevent some of those issues later in life. And that one was hugely impactful for me as well.
Yeah, no, I think both great recommendations. And there's a difference between living a long time and living a life where you've, can still enjoy life, right?
Yeah.
Not just like you said, with other issues that go along with aging. So, well, fantastic. Well, Brian, I appreciate. Sorry, go ahead.
I was going to say the quote that I heard from her. It wasn't even the author, but recently it was like they want you to die young at a very old age, and that just rung in my head. It's like that's exactly what I want to do.
Yeah. No, fantastic. All right. Well, I appreciate it. And I think we'll call it a show. Thank you so much.
Well, thanks for having me on, Keith. This was fun. Hopefully folks listening got something out of it. And if they'd like to learn more, definitely reach out.
Yeah. Thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.